Forget about the traditional markets. Forget the banks. Forget the Fed. Forget the financial tools you've been conditioned to rely on. What's happening today isn't what you're being told. There's a shift in play, but it's happening far from the spotlight. The tech giants are in a race for something far more important than your stocks or bonds: raw material. Today's crisis isn't about what you might expect. This is a race for silver, a battle not fought by Wall Street or the usual suspects, but by industrial titans who are scrambling for resources they can no longer afford to ignore. And this is something you might want to pay attention to because it changes the game. For the past 40 years, the value of metals like silver has been determined in boardrooms by financial analysts and traders sitting in New York or London. The price you saw on your screen was based on speculative deals. But today, the game has shifted. The real players in this market are no longer those financial giants who trade in paper contracts. They are the manufacturing powerhouses, the tech companies who need silver to power the future, and they're securing their positions, making moves you can't afford to ignore. Imagine this: a massive shift in the supply chain, an urgent scramble for the most essential resource on the planet. That resource? Silver. It's no longer a speculative play. It's a matter of survival for the companies pushing the frontiers of technology. And guess what? They aren't waiting around for prices to stabilize. They're already buying as much silver as they can get their hands on. Today, we'll break down how this panic over silver isn't some short-term market fluctuation. It's a deeper structural issue, the beginning of a crisis. Up until now, the silver market was mostly defined by financial institutions and commodity traders, but now it's being hijacked by industries you might never have expected. The most surprising of all? The tech giants, Samsung, Apple, and Tesla. These are the companies driving the demand for silver, not just for profit, but for survival. It's a new age, and the game is different. The old market drivers are becoming irrelevant as new players enter the scene with one goal: securing the raw materials they need to continue to innovate and produce. For decades, silver was treated as a speculative asset, traded back and forth on the commodities market. The value was determined by financial games and paper contracts. But this shift is different. What we're witnessing is an industrial pivot. These companies don't care about the price fluctuations. They care about securing physical silver to power their products. And when giants like Samsung realize their survival is tied to a metal, the game changes entirely. This is where the term inelastic demand comes in. For most buyers, if the price of a product goes up, they reconsider. But for these industrial giants, price is no longer a factor. If silver prices double, triple, or even increase tenfold, they have no choice but to keep buying. They can't afford to stop. Without silver, their products, everything from smartphones to electric vehicles and even military tech, cease to exist. Take Samsung as a prime example. Samsung SDI, their battery and electronics division, has recently launched an aggressive stockpiling program for critical metals. But they aren't just buying the usual suspects: lithium, cobalt. They've set their sights on physical silver. And this is not about making a profit in the short term. This is about ensuring their factories keep running. The reality is, without silver, Samsung's massive range of products, from phones to missiles, will come to a halt. And that's the critical issue the market is facing right now: a shortage of the perfect metal. What's important to understand is the difference between industrial players and financial speculators. Financial traders, like those at JP Morgan, buy silver with the goal of making money. If prices drop, they sell. They are weak hands in comparison to the industrial players. These tech giants, however, are the ultimate diamond hands. When they buy silver, they're not buying to profit from price movements. They are buying to ensure their products can be made. The silver they buy will not be sold back into the market. It will be consumed, turned into batteries, smartphones, or solar panels. It's gone forever. Here's the crucial part. This shift in demand is unlike anything we've seen before. We've moved from a market driven by speculation to one driven by industrial necessity. And it's these companies' massive inelastic demand that's going to be the driving force of this market. And the scariest part, the silver is disappearing fast. Once it's in the hands of these companies, it's not coming back. There's no real substitution for silver in high-end electronics or renewable energy technologies. It's irreplaceable, as where demand will outstrip supply. And we're about to see a shift that will redefine the global economic landscape. Now, let's talk about the supply side. If you've been paying attention to the markets, you know that global supply chains are already under stress. But this stress is about to reach an entirely new level. Silver, like many other essential materials, isn't infinitely available. In fact, silver production is already struggling. And as industrial demand rises, the available supply is shrinking. So what happens when demand skyrockets and the supply chain can't keep up? Prices begin to surge. Silver mining isn't as simple as turning on a faucet and flooding the market with more supply. It's a long process that takes years, and it's heavily dependent on existing infrastructure. The mines that produce silver are not growing rapidly enough to meet demand. Exploration budgets have been slashed in recent years due to low prices, and many mines are already running at capacity. As a result, new silver discoveries and production increases are stagnant. It's a scenario where demand keeps climbing, but the output can't keep up. Even more concerning is the fact that 70% of silver production is a byproduct of other metals like copper, lead, and zinc. This means silver's supply isn't directly controlled by silver miners. It's dependent on the production of other metals. So if copper miners decide to reduce production or focus on higher margin products, silver's availability further shrinks. And this is where the problems intensify. A market with shrinking resources, compounded by poor management of existing reserves. The tech giants, like Samsung and Tesla, are not sitting back and watching these developments from the sidelines. They are actively working to secure their positions in this tightening market. As we've seen with companies like Samsung, they aren't waiting for prices to stabilize. They are bypassing traditional markets, going directly to mining companies and securing offtake agreements. In simple terms, they are locking up the supply before it even has a chance to hit the public market. This is why we're seeing supply issues that aren't just speculative, they're structural. And when the tech giants secure deals directly with miners, it bypasses public markets altogether. Here's how this plays out in real time. These tech companies are buying physical silver and locking it into long-term contracts. They are stockpiling it for years in advance, ensuring they have all the metal they need to meet production goals. So, while retail investors and smaller buyers are still trying to play the market, the giants are quietly hoarding silver. And when they pull silver off the market at such a large scale, it depletes inventories and raises premiums for the rest of us. It's a classic case of market scarcity being driven by those who can afford to play this game at scale. But there's another aspect of the supply chain crisis that's playing out behind the scenes, and that's the role of governments. Green energy policies and legislation are intensifying the demand for silver, especially in industries like solar energy. These laws are creating a forced demand for silver, as countries like China and the EU ramp up their efforts to meet renewable energy targets. Solar companies are scrambling to secure enough silver to build their panels, and they're competing directly with the tech giants for this precious resource. At the heart of this, what we're seeing is a price floor being built under silver, and it's being pushed higher and higher by demand from these industries. When demand is so inelastic, meaning buyers will purchase regardless of the price, there is no natural price ceiling. A new price floor is being formed, and it's happening as a result of this strategic competition among the biggest global players. This is not a price increase driven by short-term market sentiment. No, this is a price movement driven by real-world necessity. Understanding paper markets versus physical markets. Now, let's get into something critical. The difference between paper silver and physical silver. The price you see flashing on the screen? That's paper. What does that mean? It means the price of silver is largely dictated by financial contracts, not by the actual metal itself. These are derivatives, futures contracts and paper claims on the metal. But here's the problem. Paper markets don't reflect real-world scarcity. They reflect what traders are willing to speculate. In the world of commodities, paper markets have long served as a proxy for physical prices. But in silver's case, they're increasingly out of sync. The price you see doesn't necessarily reflect the availability of the metal on the market. And here's where it gets tricky. Paper silver is not the same thing as owning physical silver. You can hold a contract that says you own silver, but if that silver is tied up in a mine or stuck in a supply chain, your contract isn't going to help you when you need it. Here's an example. Let's say a major bank holds a significant number of short contracts on silver. If they get into trouble or need liquidity, they can sell those contracts in the market, lowering the price artificially. This kind of manipulation happens regularly in the paper market. But in the physical market, those contracts are nothing more than bets on the price. The silver they represent doesn't actually exist unless someone decides to deliver it. And with the tech giants and solar companies hoarding silver, the physical market is tightening rapidly. The squeeze on real silver. What happens when the paper market gets too far out of whack with the real market? A supply squeeze. This is exactly what we're starting to see. While paper contracts flood the market, actual physical silver is disappearing into private stockpiles, bypassing the public market entirely. It's being hoarded by Samsung, Tesla, and other industrial giants who need it for manufacturing. The silver that is left on the market, though, is being bought up fast, and with it, the price rises. But here's the twist. The physical squeeze is happening in tandem with rising premiums. Even if the spot price of silver goes up, physical silver will cost much more. And the gap between paper and physical silver will only continue to widen. Why it's not a bubble? It's a revaluation. Some people will call this a bubble. They'll look at the price spikes and say it's unsustainable. But the truth is, this isn't a bubble. This is a revaluation. Silver has been undervalued for decades, suppressed by financial manipulation and market forces that didn't take into account the real-world demand. And now, those dynamics are changing. When the real demand begins to outpace supply, the price will naturally adjust to reflect that reality. It's not speculation, it's just reality catching up. This is where the problem lies. Liquidity. There's too much paper silver in the market that can't be converted into physical metal when the pressure mounts. The liquidity is drying up. The miners, who are already struggling to meet demand, can't suddenly ramp up production to meet the needs of these industrial giants. So what we're seeing is a disconnection between the paper market and the physical market that's creating volatility. In essence, there's a gap between the contracted promises and the actual physical metal that's available to those who truly need it. Now, when we talk about liquidity crisis, we're not talking about a slow market shift. We're talking about real-world consequences. What happens when an investor or company tries to withdraw physical silver from the market, but it's simply not available? They are left with two choices. They either pay sky-high premiums to get the silver they need, or they wait, hoping for a delivery that may never come. This is where the market is headed, increasing premiums, increasing volatility, and a supply chain crisis that makes the market for physical silver behave less like a financial market and more like a strategic resource. The long-term outlook. Why it's not just about silver. So let's zoom out for a second. This isn't just about silver. This is about a much broader shift in the way global markets operate. Silver is the first domino in a series of cascading events that will redefine the future of commodities and resource-driven economies. What we're seeing right now is the beginning of a larger movement, one where essential industrial metals are increasingly treated as strategic assets, not financial tools. And silver, because of its irreplaceable qualities, is at the center of this transformation. The battle for silver is only the beginning. Tech companies and solar giants are not just looking at silver, they're going after everything from rare earth metals to lithium to cobalt. These resources aren't just important for tech gadgets. They are the foundation of the future energy economy. And when companies like Samsung, Apple, and the biggest solar manufacturers in China are stockpiling these materials, it's a sign of what's to come. As industries shift to green energy, the demand for these critical materials will skyrocket. This is an industrial arms race, but instead of bombs and missiles, it's about the physical metals that power the future. But here's the kicker. The tech giants are hoarding. It's not just about securing enough resources to meet their current needs, it's about securing their future. When a company like Samsung enters into long-term agreements to lock down silver supplies from mines, they aren't just buying a commodity, they're buying the future. They know that silver will become increasingly harder to find, and they're ensuring their factories won't stop running when the shortages hit. That's why they're making these deals in secret, far from public view. They are securing their future supply chain before it's too late. For those of us who are watching this from the sidelines, it's easy to get caught up in the fear and panic. But what if, instead of being caught in the emotional selling spree, we positioned ourselves in a way that actually benefits from this industrial shift? What if we looked at this not as a temporary spike, but as a fundamental market change that's coming to fruition right in front of us? Investors who recognize the reality of this supply and demand imbalance will be the ones to benefit. Those who hold physical silver, for example, will be in a unique position when prices continue to rise. You won't be trading paper contracts. You'll be holding a piece of the future. As we move forward, the reality is that this won't just affect silver. Other metals that are critical for the green energy revolution, like copper, lithium, and nickel, will follow the same path, and eventually, we will witness a broader shortage of resources across the entire energy and tech industries. This could lead to significant revaluation in markets across the board. The era of cheap metals is over, and companies like Tesla, Apple, and Samsung are the new gatekeepers of these vital resources. But here's the question we all need to ask ourselves. Can the miners save us? The short answer is no. The mining industry is already stretched thin. Mining production has been stagnant, and the geological reality is simple. We're running out of easy-to-access deposits. The gold rush mentality won't work in this environment. We are facing a supply cliff where demand for key metals will far exceed the available supply. Mining will take years to catch up, and by then, the major tech companies will have already secured their resources. So, where does that leave us? For the everyday investor, this is a wake-up call. We're entering an era where physical silver, and by extension, other strategic resources, will become more and more valuable. The banks and the big investors who once controlled the price of silver no longer have that kind of power. The true force behind the silver market is being driven by the industrial giants who need it to survive. This isn't speculation. This is about the realities of supply and demand in a changing world. And the smartest people will be those who see the shift coming and position themselves accordingly. The future isn't about avoiding the market. It's about strategic positioning. The future of silver and the future of tech is being written right now. And the best part? For those of us who have the foresight to understand the true value of these resources, we'll have the opportunity to not just survive, but thrive. This is not just a crisis. This is the opportunity of a generation. So, as we look ahead, don't let fear dictate your actions. This is about real-world demand, not speculation. It's time to secure your position in a market that's only going to become more valuable as the years go by.